But have we turned the corner as far as the correction goes? What are the factors at play? Let's discuss all of that with Mithun Aswath joining us today, a fresh new guest on the show. Of course, he runs the outfit Kivah Advisors. Mithun, good afternoon. Thank you so much for your time coming on the show today. How are you really analyzing? Let's get your overall hypothesis on the market right now. The way factors are at play, crude crumbling down, at the same time, fresh lockdown fears in China. So, how are you looking at the medium term and near term factors at play?
Yeah, hi. Good afternoon. Thanks for having me, Ajay. I think in the near term, I think the market is obviously tentative because of the geopolitical risks and how commodities have spiked. Even leading into this Ukraine-Russian standoff, inflation was a concern globally, and this has just exacerbated the same. And India, being a large importer of crude, will obviously be impacted on the macro front. And that's what I think the market is also trying to price in respective stocks and sectors. Our own sense is now crude has actually come down a bit after touching highs of about $130. It's back down to about $100. And there is also talk that maybe India is likely to negotiate, discounted crude for purchases. Now, I think around the $70 to $80 level is something where India can still withstand because this excess amount of spend on crude will obviously hurt the fiscal deficit. And on the other hand, if the government passes on the entire burden to the consumer, there is less money in the hands of the consumer. So I think that is what the market is grappling with. At this stage, I think certain sectors which are impacted in the near term would be, automobiles and FMCG companies, which have already been trying to pass on price hikes earlier, will now again need to be able to pass on even more. And that is the question, whether they will be able to pass on and the consumer will be able to take those hikes.
Right. Mithun, what's your own investing framework right now? Be it advice to your client or running your own portfolio, what's the hypothesis you're forming in your and using it in your portfolio construction?
I think, Ajay, the best way to look at the market right now is more on a bottom-up basis and look at some structural themes which are positive on over the next 3 to 5 years. So certain things that we like are areas even in consumption which are more aspirational in nature. So for example, even in amongst the retailers have had quite a hard time over the last couple of years due to COVID. This could be the first year where they have a normative year. And a lot of these companies are still trading reasonably cheap. So that is one space that we think is structurally well poised, and especially brands which cater to the aspirational segment will do well. In the same line of thought, we also like travel and tourism. That's a space which has not really taken off due to COVID. International tourism is likely to pick up in a big way in the next coming months, as even the government has now opened the skies for international travel. And I think from March 27th, there will be more flights for international travel, and that will also help and provide an impetus to the sector.
Right. What are the areas of the market which you find incrementally positive in the small and the mid cap? Have you identified some areas where you'd like to build position if the market falls a little more from here? Your thoughts on the broader market?
I think if someone was to see through this pain, I think there are certain pockets even in the automobile sector where there is pent-up demand. I think the only concern is on supply. First, it was due to the semiconductor issue. Now there is an issue because of the Russian standoff, because there are certain raw materials that semiconductor companies require from Russia. Having said that, over the last 1 or 2 years, you have not seen auto sector really pick up. There is inherent demand there. There are some hurdles that they need to face, but there are certain opportunities there, even in the auto component side, which have started to look attractive with this recent correction.
Right. Mithun, what are your thoughts on earnings quality? The portfolio which you hold right now, have you assessed the damage, high commodity prices, high input prices, in some cases high energy prices because they are the input? All of that is likely to play out for the next 2-3 quarters. And because of that, how much earnings downgrade may be required?
Yeah, I think we have exposures across sectors, be it IT, some exposure to pharmaceuticals. There are exposures even to the consumer and retail segments and tourism. Some of these pockets are not really impacted by the crude price going up or commodity prices going up. However, what we need to foresee and we will only know over the next few weeks is whether this also causes an impact in terms of demand, because all of us were projecting some sort of growth incrementally over last year. Now, is that at risk is the key monitorable across sectors that we need to monitor, because earnings growth was expected to be reasonably good even in FY23, and because of this inflationary headwinds, whether there will be an impact on the top line. I think that is the key risk, because some of these commodities going up could be more transient in nature, and you may see a correction over the next 2-3 months. We've seen that even historically, whenever crude has moved very rapidly, the 3 months post that, you've seen a sharp correction. Already we've seen 130 come to 100. Now, if the supplies improve and the standoff between Ukraine and Russia dissipate, then crude may even come lower. So we need to just see how much of this is actually hurting in demand. From our own channel checks, at least on the building material side, we still see very strong demand, especially in segments like paints or ceramics or sanitary ware. I don't think the demand has come down despite the current environment. So we need to just maybe see how things kind of proceed on the commodity front, and then we will get a better picture and handle on this.
Any thoughts on the Relentless FIS selling? I mean, we've seen $38 billion in last over a year, crossing the 2008 number of 28 billion, and still markets are relatively firm. So the bull argument is that market has been very resilient in the face of selling. The bear argument is, what if DIs also start selling along with FIs? Any thoughts there, Mithun?
Yeah, I think the good part is I think the investors that we have now on the mutual fund side at least seem to be a lot more resilient. The SIP flows continue to remain quite strong even in the month of February. And if you look back, even during the COVID pandemic, I thought we saw very large inflows from the domestic investors. So I think that may be a structural scenario where investors don't have too many other options to invest in to beat inflation, considering interest rates being so low. So if that remains quite solid, we actually may see, the FIs also come back when valuations become reasonable. And that actually could act as another lever for the market to go higher than lower.
Fair point. Any thoughts on this new fear of stagflation, elevated inflation and slow growth, which some strategists on the street have started talking about? In these kind of, and when clouds of stagflation are also around, how do you see equity as an asset class in generally to behave?
I think it's very difficult to make these sorts of statements and thoughts because things are moving very rapidly. If you just see what's happened in the commodity side over the last 2-3 weeks, you've seen oil move from 75 to 130 back to $100. And all these can change very quickly. If oil comes back to 80, there could be again an upgrade cycle starting. Because I think one variable which was an uncertainty which is out of the way is the elections in the 4 states where, especially the large state of UP where the BJP was able to win, that provides at least some sort of policy framework continuity. And we actually quite positive on that part because if you look at the budget was not too meaty. And you've seen this government before also do things out of turn, not in the budget, but announce a lot of reforms and policies even in between. So I'm actually hoping over the next few weeks, if the government actually uses this time to maybe announce certain policy decisions which could be impactful for the markets. At the same time, hopefully they do not lose steam even on the disinvestment program which they have started. So I think these are things that are more structural, especially if we have continuity in policy.
Right. All right, Mithun, we'll let you go on that one. Thanks so much for joining us with your thoughts on the market and investing. Let's